So Rick, what's your take on economic cycle in the US? Where are we now? Whether we are stepping into recession?
It's really not fair for an economist to ask me about the economy. But everybody has an opinion, just like everybody has a belly button. Sometimes you don't want to see those things. I think we're looking at a gradual slowdown in the U.S. economy right now. We've seen consumer spending slow down a little bit. As you know, consumer spending makes up about 70% of the U.S. gross domestic product. The GDP continues to surprise most forecasters, being a little bit stronger than everybody expects it to be. But there are some signs of weakness. We've seen unemployment go up sequentially over the last 3 or 4 reports. Still relatively low historically, but it's been moving up. Job creation saw a revision from the Bureau of Labor Statistics recently where they took out 818,000 jobs that we thought had been created, but actually had not been. Wage growth is slowing down a little bit, and the consumer debt load is at an all-time high. I believe it was about $18 trillion in household debt. Now, about $13 trillion of that is mortgage debt, and nobody's too concerned about that because there's also $34 trillion in homeowner equity. But if you look at $1.6 trillion in student loan debt, $1.3 trillion in credit card debt, $1.5 trillion in auto loan debt, and you see delinquency rates on those payments going up. While I don't know that we'll hit a recession, the economy is definitely poised for a bit of a slowdown after a few years of steady growth.
Real-time inflation in the U.S. is already below 2% of the government wants to set at 2% inflation. So we are clearly went rapidly into a lower inflation. And maybe, if the inflation is even lower, we might really go into recession.
Before we leave inflation, I think it's important that we recognize that even with inflation numbers coming down, that doesn't mean that prices are going down. And
that's true.
I think people get confused about that. Lower inflation just means the prices are going up more slowly. So I don't like the government's reports for a couple of reasons. You mentioned the delays. But the other thing I don't like is the inflation numbers don't reflect what's happening in everybody's household. So I've created my own CPI.
Wow.
I hope that's okay. It's called the Costco Price Index, CPI. And I look at the salmon that I bought a year ago, and it cost $9.99 a pound. Same kind of salmon this year is costing $12.99 a pound. Now, that's not 2% inflation. That's not 9% inflation. That's a 30% increase in prices. And the average household's under a little bit of financial stress. And so when we talked about the credit card debt a couple of minutes ago, credit card debt is at an all-time high. Because the Fed has raised the Fed funds rate so significantly, the interest rate on credit cards, don't know if you've looked lately, ranges between 25 and 35%. So we have an all-time high in credit card debt at a time when interest rates are high enough that they used to get somebody arrested for trying to have interest rates that high. And personal savings rates are almost at an all-time low. So my concern is that the consumer is tapping into credit lines or tapping into their savings to make ends meet. And that's why the Federal Reserve has been so adamant about getting inflation under control so that people can afford to live. And it is a bit of a concern.
Okay, so next question. What's your prediction for the house price in the U.S.? Would it continue to go up?
Yeah, I've been saying for the last year that I thought that this year home prices would end the year up about 3 to 5%. It looks like we're tracking right along that by the end of this year. I also believe that we'll see prices go up next year. There are people on YouTube who will tell you that the house price crash is coming. If you just pay them $4,000, $5,000, $10,000 for their special course, they'll teach you how to profit from that. Don't buy those courses. I think supply and demand will continue to rule the day into next year. So we didn't get to this part yet, but if the Federal Reserve does start reducing the Fed funds rate, we will start to see mortgage rates come down. We've already started to see mortgage rates come down. If they go down a little bit further, we'll see more buyers come to market. But we won't necessarily see more sellers come to market, I don't think, until the mortgage rates are down in the low 5% range. What that means is we have more buyers, limited supply. That almost always results in home prices going up. So I don't see a house price crash in the future, at least not in the near future. What I do see is a couple more years of relatively slow home sales and relatively slow but steady increases in home prices until we reset at these new mortgage rate levels and it becomes sort of the normal market again. But that's the way I think we're going to be looking at a couple of years where home prices go up 3, 4, maybe 5%. And keep in mind, I'm talking nationally. Your market may be different. If you're in Austin right now, prices are going down. If you're in San Francisco at the high end of the market, there's a little bit of price pullback. So there are markets in the country, Boise, Idaho, where prices went up 47% in a year a couple of years ago. There's a clawback now, and we're seeing people selling for lower prices. So national numbers will go up, but you will have markets where prices are going down a bit.
The real estate market, housing market, the most recent data till end of July, national average housing price versus last year was up 2%. So it's actually not bad. But on the other hand, it said that the transaction volume declined a lot. The price is still going up, but there are a lot less people buying and selling houses. Apparently, the volume went down almost 50% now versus last year. So yeah.
July was the 36th consecutive month where we sold fewer existing homes than the year before. We're right now running at about 4 million sales a year. To put that in perspective, we crossed the 4 million sales mark back in 1978.
Wow, so that's very low.
We're back lower than we were during the Great Recession. New home sales are up a little bit. The builders are using a lot of incentives to get people to buy their homes. They're writing down mortgage rates. They're reducing prices. They're adding upgrades to the properties.
So I guess, Rick, what's the impact of Fed fund cut to the real estate market?
Why don't you start this time, and then I'll chime in.
Okay, sure. So I'll be happy to give you kind of a rule of thumb on Wall Street, which is that if you cut 1% interest rate, the housing price go up 10%. If the Fed cuts 25 basis points, then you're expecting the housing price to go up probably 2.5%.
When the Fed started raising the Fed funds rate, which is a short-term interest rate, it's the overnight rate, we saw a pretty remarkable impact on longer-term interest rates, on mortgage rates. They doubled. They went from about 3.5% to 7% in just a few months. That, according to Freddie Mac, that's never happened in U.S. history where mortgage rates doubled in a single year. So that's the first time ever, and that's why affordability got so challenging for a lot of buyers. When you're trying to forecast mortgage rates, I look at the yields on 10-year U.S. Treasuries. So if you look at a yield on a Treasury, let's say it's 4%, you add 1.5 or 2% on top of that, and that's usually what the mortgage rate is. So if you have a 4% yield on a 10-year Treasury, your mortgage rate should normally be 5.5 to 6%. I believe mortgage rates have at least a full point that they can come down. That means that in the next year or so, we should start seeing mortgage rates get down to around 6% or maybe even into the high fives. And when that happens, I think we will see a significant impact on the volume of at least buying activity in the market. When you get those buyers coming to market in these new environments, you wind up seeing home prices go up. So it's still going to be a slow recovery.
What would be the election impact to the current real estate market in the U.S. and next year's market?
So if you look at these things historically, what you find out is that presidential elections almost never have a big impact on the housing market. Home sales slow down right before the election, and then they pick up right after the election, and it almost doesn't matter who wins. What I'm more concerned about is the environment for real estate investors going forward. So there have been some proposals made. There's some legislation running around Congress right now that would affect anybody with more than 50 rental properties. Anybody with more than 50 rental properties, the government is looking at calling an institutional investor, which is just goofy. If you look at the big institutional investors who own thousands and thousands of properties, Altogether, collectively, they own about 3% of the single-family rental homes that are out there. Mom and pop investors who own 10 or fewer properties own about 90%. There's a concern about things like capital gains taxes going up to 44.5%. That's a problem for investors. There are talks about taxing unrealized capital gains, which has never even been thought about before, which could be a problem for investors with larger portfolios. On the other side of the aisle, there's talk about getting private lending back and reducing the government's footprint in the mortgage industry. And if that's not handled properly, there will be utter chaos in the market because nobody will be able to figure out how to get a loan. So there are good and bad parts about both parties' platforms, if you will, some of the ideas being tossed around, but I'd encourage you to look at the kind of proposals that not just the presidential candidates are talking about, but your local politicians, your senators and your Congress people as well. Think about the implications for you as a real estate investor.
So next question, migration. So what's the current trend of a population and job market? Which states or metropolitan areas do you think are particularly interesting for us to invest in the near future? I'll start then. At least for us, we've been focusing on one area only, which is southeast of the U.S., about, I would say, 15 states, from North Carolina, South Carolina, Georgia, Florida, and a little bit in Kentucky, too.
My son's a teacher. He's getting married next month. His fiancée is an attorney. They sat me down a few weeks ago to ask me what states they should be looking to move to so that they can someday buy a house. And I guarantee you that conversation is going on at kitchen tables up and down the coast. So we see a lot of people moving to the Midwest. We see a lot of people moving to the Southeast in particular. If you look at full migration patterns last year, the state with the largest number of people moving in was Florida. Florida was also the state with the most out-of-state real estate investors. So that Southeast corridor, Florida, Alabama, Tennessee, Kentucky, North Carolina, South Carolina, hotbed of growth. We're seeing a lot of the institutional buyers buying rental properties in the Midwest, Michigan, Wisconsin, Indiana, because they can buy properties at a low cost, rent them out at a reasonable rate, and get good cash flow. So I mean, I follow the people that are smart with their money, and a lot of money's going there. If you want my hidden gem of a state, don't tell anybody, this is just our secret. It's Ohio.
Oh, wow.
Columbus, Ohio has been the most remarkable market over the last decade that nobody ever talks about. It has a great healthcare industry going on there. You should probably buy some properties. It is the home of the Ohio State University. Intel just announced they're building a fabrication plant just outside of Columbus. The state of Ohio is a haven for investors right now, if you know where to look.
Ohio has a lot of finance jobs too. JP Morgan has a major operation of their asset management team in Ohio, in Columbus. They have a lot of people there. So next question, any investment opportunities in commercial real estate that you can discuss with us? Considering right now there's a lot of loan maturities in the sector and a lot of stress going on in the commercial real estate.
Anybody want to buy an office building really cheap? So there are about $600 billion in mortgage-backed security loans coming due this year. It was about $500 billion, but $100 billion got moved from last year into this year to delay their maturity. We're seeing office buildings in San Francisco and Los Angeles sell at 25 or 30% of the last sale price. In the central business district of San Francisco, the vacancy rate is over 40%. Parts of Los Angeles, the vacancy rate's over 35%. In parts of Manhattan, the sublease levels are at an all-time high. The good news for the commercial market is it does look like things have bottomed out, and we're actually starting to see prices stabilize and in some cases start to come up a little bit. The central business districts of very large metropolitan areas, San Francisco, New York, are still kind of vulnerable. There's still a lot of inventory, not a lot of people going to the office in those markets. But you don't want to cover the whole commercial market with that blanket. Class A buildings in the same markets I just talked about are largely full. So they're doing okay. If you go to suburban markets, mid-size cities across the country, those markets are doing pretty well too. There will probably be some bargains in the multifamily industry. There were some syndicators who over-leveraged, buying up multiple multifamily units across the country. Their notes came due, and they couldn't make the numbers work with today's higher interest rates. So they're selling these properties off or letting them go to foreclosure. So there are going to be opportunities. You just need to be paying real close attention to what's going on in your market. Industrial prices have slowed down quite a bit, but there's still a lot of opportunities for warehouse and distribution centers, for cloud computing centers, for cannabis facilities. The hotel market is probably going to see a little bit more attrition, particularly small limited service hotels like Marriott Fairfield Inn and Hilton Garden Inn and those kind of properties that tend to be owned by small investors. So yeah, there will be opportunities. We probably have hit the bottom in terms of pricing, so I wouldn't be looking for another 10-20% decline in prices. But be very careful when you're buying those kind of properties. You know, take a look at the leases that current tenants have. Take a look at payment history for those tenants. Take a look at what's going on in terms of monthly rates for your new tenants. So I'd say commercial market has some opportunities, but proceed with caution.